Hello students, this is Professor Faiz Raut from Jain College of Engineering. We are in the revision lecture of Module 3. In Module 3, we have studied regarding the capital budgeting, the financial evaluation of mergers and acquisition. In that, merger as a capital budgeting decisions, then valuation approaches, asset-based, market-based and income-based approaches, and exchange ratio, which is also called as swap ratio, and how to determine this exchange ratio or swap ratio. Well, I have given some video lectures regarding the swap ratio or exchange ratio, which the type of a sum which comes in your final examination, and there are 2 to 3 types of it, which will be dealing with the exchange ratio problems. While in theory, the first part is about capital budgeting. Capital budgeting is what it is: the target company and acquiring company of a merger evaluate each of the resources by capital budgeting format and hence come to a conclusion of merging themselves together. Okay, as we have studied in the first and the second module, the acquirer company does the entire due diligence, entire investigation of the target company, and which company to choose as a target company, and then evaluate that company on the basis of asset, on the basis of other resources or other kind of benefits which he will be receiving from the target company, and then accordingly he will select the target company and try to acquire that target company. And after acquisition, that acquirer company will try to integrate with the target company's shareholders, the target company's employees, the target company's buyers, suppliers, and all the other stakeholders. Well, in capital budgeting, this is the process of one of the process in which the acquiring company will analyze the target company, and in turn target company will also analyze its own company in order to give a certain what do you say in order to give a certain figure to the acquiring company, so that they'll negotiate on that amount of to sell their company. So they'll be doing in 3 steps. First is the financial statement. Both the companies will analyze the financial statement. This is the most important thing for acquiring company. Basically, the acquiring company will analyze the financial statements. It will see the cash flows, the debts, the profits, the other expenses of the target company, and find out whether it is a good buy or not. Then it will analyze the balance sheet properly. That will help what are the assets and liabilities, or what are the financial leverages, what are the debts which the target company has. Okay, that will be analyzed by the acquiring company. And finally, the cash flow statements: how much is the cash available in the target company's books of account, in the cash flow statements, how much is available, and what can be used and what needs to be paid. So that will be done in the capital budgeting process by the acquiring company. Okay, and there is a process of capital budgeting. Okay, before that, I'll go with decision of a merger. Well, it says merger decision requires comparison between expected benefits with the cost of acquisition of the target firm. Okay, and the decision criteria is to go for a merger. If NPV is positive, the decision would be the decision criteria to go for a merger if NPV is positive. The decision would be against the merger in the event of NPV is negative. Okay, as we are dealing and analyzing the target company according to capital budgeting, we will be calculating the net present value. We'll be analyzing what is the net present value of the target company, and depending upon its value, the acquiring company will be deciding to go for a merger or to not, or go against the merger. Okay, that means the net present value, the benefit which the target company is giving after acquisition. If that benefit is more than the cost of acquisition, then the NPV will be positive. Then the acquiring company will go for the merger. If the benefit what the target company will be giving after merger is less and the cost of acquisition of the target firm is more, then definitely the acquiring company will not go for a merger. It will be against the merger. Okay, so this is how the decision will be taking place by the acquiring company. Okay, and there are steps for the NPV calculation. Okay, first step is to determine the incremental projected free cash flow to the firm. Then after that, this incremental projected free cash flow you must have studied in the second semester, in which the projected free cash flow will be found out depending upon some assumptions. Uh, s- uh, Depending upon some assumptions, free cash flows for period of maybe 5 years or 10 years will be calculated. Then those will be discounted, and the present value will be calculated. Okay, and the second one is determination of terminal value. The terminal value is the value after 5 years or after 10 years, what will be the value of the company at that time, of the entire company at that time. That will be the calculation of terminal value, and later on you will discount that terminal value as well as the free cash flows to the firm. Then you will determine the present value of free cash flow, and then determination of cost of acquisition. So you will subtract the cost of acquisition to the free cash flows. Okay, and then you will get the net present value. Okay, next is about business valuation. Well, there are three ways in which business is valued. The major three ways are: first is market approach, second income approach, third is asset approach. Okay, we have dealt this in detail in my videos, in my previous video of third module. Okay, I'll just go through these three. Market approach is when you take when you're valuing a company which is available basically in if in stock market, or that company is very well known in the market, and there are competitors of those company which are also there in the market, and the data you can extract it very easily. So for those type of companies, you will take your target company, and then you will analyze your target company by comparing with its competitors. Okay, the example which I gave you was about TCS. When you are valuing TCS, the Tata Consultancy Services, then you will be comparing that company with the Infosys. So TCS and Infosys will be compared, and accordingly the fair market value will be calculated. So this is how will be done in market approach. You can take dividend, or you can use the other data of those companies. So there are types in market approaches. Okay, then next is about income approach. In income approach, this approach assumes that the value of the business is equal to the present value of the economic income expected to be generated. Okay, so if we are valuing a company using this method, then we should estimate the income or the profits which is expected in the future, or what is the profit in the present. From present to future, what will be the profit of that company will be, and that we will compare it with the previous financial data. So in this method, we are not comparing with other companies' performance, but we are rather comparing with the same company's previous performance, and how it will grow in the future. So this is how the income approach is. So we'll take the income of the company, and we will compare with the growing income of that company, and we'll compare it with the past income of that same company. Okay, so there are other types in income approach as well. Okay, then next is about asset approach. Okay. Asset approach is also called as the cost approach. In asset approach may be applied when the benefits of operating a business do not outweigh the value that could be derived through the orderly liquidation of the assets. Okay, so in asset approach, we will take the assets of the company, and then we will value the company. In this, net asset value method can be used, or adjusted book value method can be used. Okay, in asset approach. Okay. Next is about the exchange ratio. Well, exchange ratio, in this, when the acquirer company is planning to buy the target company, they will offer the shares of the acquirer company to the target company shareholders, and in the exchange of target company's shares. Okay, that means if company A is the acquiring company and company T is the target company, so the shares of company A will be offered to the shareholders of company T in exchange of their shares. Okay, suppose that company A will offer one share for every one share of the target. So now the shareholders of the target company will become the shareholders of the acquirer company, and the shares of target company will be invisible, will go off. Okay, so there will be no shareholders of target company left. All the shareholders of target company will become the shares of the the shareholders of acquirer company. Okay, so in this case the acquirer company is not spending any amount, it is only issuing the shares of the share of its company, and the target company shareholders, if they agree, they'll be happy with the shares of the acquirer company. Okay, so they'll be getting the capital appreciation or dividends of the acquirer company's shares. So in this case, there is no exchange of cash with the target company shareholders. Okay, in this case only the shares will be exchanged. So in what ratio the acquirer company will give the target company the shares, that is called as the exchange ratio, or else the swap ratio. Okay, so the target company can tell, okay, for every one share of acquirer company you need to give 5 shares of target company. So the exchange ratio will be accordingly, and suppose it can be for every one share of acquirer company, the target company will be giving 0.5 shares or 0.6 shares. Okay, that decimal amount can also be there. So the formula for exchange ratio is offer price divided by the share price of the acquirer. Offer price is the offer given to the target company shareholders. Okay, this offer price, so numerator will always consist of the target company's shareholders thing. It can consist of the EPS of target company, or it can consist of the market price of the target company, or any offer which the acquirer company is giving to the target company shareholders. So related to target company, the numerator will be numerator will consist of anything which is related to target company shareholders, divided by the denominator will always consist of anything related to acquirer company shareholders. So this is how and this formula is quite important for your sums, for your numericals. Okay, so this was all about the exchange ratio. Okay, thank you for listening.